Hello, I'm Sean Hurro. I'm a mortgage advisor, and I want to walk you through different ways that you can use the seller's money to your advantage in a market like this. You see, what we normally default to is if we see a property sitting on the market, we're going to think about negotiating. We think we're going to negotiate a lower price. And while that is a good strategy, it may not be the best strategy, or it may not be the best place to start. Because when you're using a mortgage to buy a house, the cost of the money is more important than the cost of the house, or at least it helps to determine affordability more. So I'm going to walk you through some details here to show you the different ways you can go to take advantage of the seller, we'll call it. Here we go. All right, so what I did is I modeled out a purchase price of $700,000 and I did 20% down just because that's what everyone's used to. You do not need 20% down to make any of these strategies work. It works with as little as 3% down if you're a first-time home buyer. So don't get caught up in the down payment. Just focus on the concept here. But what I wanted to compare is we have a list price of $700,000 and the property's been sitting around. So we say, oh, you know what? Let's offer them 5% less. Let's try and get the house for $665,000, removing $35,000 in price. That's 5%. Well, if you did that, you would end up saving about $208 from the list price. But if we took that $35,000 and use it in a different way to buy down the interest rate, it'll save you even more money. So if you look at the third column here, what you'll see is we left the purchase price at $700,000, but I'm applying the $35,000 as a credit to closing costs. And one of those closing costs can be to buy down the interest rate and pay what's called discount points. You're able to discount the rate below market. One misconception that happens a lot is we think that the lender controls the interest rate. The fact of the matter is there are multiple rates available every single day, and you have the ability to choose which one you want. And with this strategy, we can have the seller pay that cost. So by leaving the price at $700,000 compared to lowering it to $665,000, the monthly payment is $3,921. It's about $150 less per month than if you had lowered the price with the standard rate. I love this option when we're trying to qualify for more house, because the way the loan qualifies is based on the interest rate. So when you do a permanent rate buy down, like we're illustrating in this option, you're able to qualify for more house because you have a lower monthly payment. That's going to give you more wiggle room. It doesn't mean you have to qualify for more. This whole process is about finding your comfort zone in both monthly payment and cash out of pocket. I want to make sure that no matter what you choose, it feels comfortable. Now, another way to use their money is using something I'm using a ton right now called a temporary rate buy down. The temporary rate buy down, you're going to get a much deeper discount in the interest rate, but it's for a smaller period of time. So if you look at the fourth column over, you'll see we had the same thing, a $700,000 purchase price, but I got the interest rate down to 3.5%. We're discounting it by 3% for the first year compared to the normal rate, the full note rate of 6.5%. So with this loan type, you get a discount on interest in the first 3 years. Year one, it's 3% below your fixed rate. Year two, it is 2% below your fixed rate. And in year three, it's 1% below your fixed rate. Years 4 through 30 would be the normal rate that you have on your note. So a 30-year fixed at 6.5, you know that years 4 through 30, your payment will always be the same. It's one of the reasons I like this more than adjustable rate mortgages is because there's no variables. I know what it's always going to be. But by using this option, you get a substantial savings. In the first year, your monthly payment is $933 less than if you paid the full list price. It is $700 less than if you did the price reduction, and it's about $400 less than if you did the permanent rate buy down. Again, I'm only comparing year one. Year two, the payment will be higher. Year three, the payment will be higher. And then year 4, it would be the same. Well, with inflation driving interest rates, so right now interest rates are inflated because of inflation. They're higher than they should be because of inflation. Well, we know that inflation is going to come back down and mortgage rates are going to follow suit. So I think anybody who's buying a house in the current market is most likely going to refinance in the next 1 to 2 years. Worst case, if I'm wrong, you have 3 years of security knowing that you're staying below, at least 1% worst case below the actual rate. So now, yes, this is much more complicated. I'm trying to explain this quickly to get through the video as fast as I can because I know you have other things to do. So if you want to schedule a call with me, go ahead and click the little QR code in this presentation and you can schedule a Zoom, a phone call, or you can apply if you're ready to do so. I want to make sure this makes sense because, yes, doing a price reduction, conceptually, it's much simpler, right? We understand that. We do it all the time. We want to get something on sale. It doesn't mean it's the best strategy for your long-term savings. And that's what my goal is to find the best path. I want to show you all of your options so you can make the most educated decision. And if you like what you're looking at, we call this a buyer's guide. We build it for every single client to make sure they're able to make the most confident and educated decisions. So that's it for now. If you have any questions, feel free to call, email, or text me anytime. Thanks so much for watching this, and I will talk to you soon. Cheers.